Expect 2022 to be the worst year for U.S. equities in history. That is the very grim forecast of my next guest. Harry Dent is the founder of HS Dent. He is known as the contrarian's contrarian. He's an economist and best-selling author. Harry, thank you for joining us.
Yeah, nice to be here, Michelle.
All right, well, Harry, it is good to have you. Although you are the bearer of bad news, you think that 2022 is going to be a terrible year for the markets and the economy. Now, the Fed minutes spooking the markets today, indicating a more aggressive Fed and a tapering schedule that'll be moved up, raising rates possibly as soon as March. But just how dire is your forecast for 2022?
Well, okay, first you got to remember, I was the most bullish guy in the whole country in the 1980s when this boom was just getting going, and people thought, oh, this was just a short-term thing. You know, people thought Japan and Asia was going to take over the world and the U.S. was dead. So I've been predicting the greatest boom in history, and you can't have the greatest boom in history without it coming down hard and strong and having a big crash. That's just the nature of markets. They go both ways. But what's happened uniquely here, the markets did peak in late 2007, as I've been warning for a long time, when baby boomers were peaking in their spending curve all the way from 1983 to 2007. That is when people keep hitting age 46, their peak spending in higher numbers. And what happened in that crash in 2008 and 9 is the central banks panicked and they just said, well, we can't have a depression. And that's what it looked like. And that's what it would be like after such a great boom, just like the roaring 20s and in the early 30s and the Great Depression. And so they've been printing money ever since. And then when they hit COVID, they printed more money in the last year and a half or two than they printed in the 10 years before that. So we're in this basically confrontation between central banks desperately printing ever more money to keep us from shaking out the greatest bubble in financial assets in history, the greatest debt bubble in history, and now global more than any time in history. This is a big deal, but it's bearish only because we're coming out of the most bullish period in history. So it's not a bad story. We have to shake out these excesses, or the millennials will never be able to invest at reasonable rates, and the economy can't rebalance and prepare for the next boom. And again, I've been predicting the next boom forever would be the millennials from 2024 into 2037. Not as long as the baby boom and not as steep, but we will see another boom to follow this in the US and more so in Asia, especially India this time, in China and Southeast Asia. So there's more boom to come, but we have a major, this is going to be the biggest crash, right, the biggest downturn of your lifetime is what I'm saying. And most of it's going to happen probably in 2022.
Like how big in terms of percentage?
Okay, so first of all, I've studied every major bubble in history and the first crash. Now, I'm just saying the first crash, when the bubble finally gives, okay, like in 1929, you know, or in 2000, in May of 2000, when it first crashed. The first crash averages 46% in just 2.6 months. Now, when a major bubble of this magnitude, like 1929 or 2000 or now 2021 crashes, the whole crash tends to be about 80 to 90%. 1929 was down 89%, 78, in 2002 crash, the NASDAQ was down 78%. I'm saying stocks in general in this crash will be closer to the 29 to 32 crash. I'm estimating 87% for the S&P 500 and maybe slightly higher for the NASDAQ. So this is not something to sit through and just rebalance, as financial advisors say. Yeah. You have to get out of the way of this, and then we will have the buy opportunity in investments of a lifetime in around late 2023 or so.
Okay, so a very deep and steep decline of about 40% plus over a 2 months period.
The first crash, the whole crash is going to be 80 to 90%.
Right. Well, but Harry, the last time you were in Kitco, you told my colleague David Lynn that you expected the stock market peak in January of 2021 and then a major crash, much like what you're describing now, by April of 2021. You were calling for a 40% crash by April. You then said that June would be when the markets would collapse. Obviously, very hard to time the markets, but the S&P 500
it is
closed
extremely
out.
hard to time something
Right.
not natural. I predicted the 2007 top 20 years before it happened. That was a natural boom driven by real consumers and investors. You've got governments fighting this crash, and so it is impossible to predict exactly when it's happening. I am telling you, and I will stand by this, we are going to see, and I think it's going to happen in 2022. You cannot tell exactly, but the signs are recently. What we've seen one index from the corporate bonds to then the small caps and Bitcoin, and then the NASDAQ peaked in November 22nd, and it looks to me like the S&P could have peaked basically yesterday. So we see the succession of peaks down into narrower, more large cap. That's a classic long-term top. That's why I'm saying it's likely now, but there is no way to tell this until it happens. But I am warning people with unbelievable analysis in history of every bubble, major bubble in the last 150 years, that first crash will be 40 to 55% so fast you will not see it. So if you wait to see if I'm right and take that risk, you are going to be hit very, very hard. And history is very clear about that. No exceptions to that.
Okay, but Harry, if people had listened to you in April of last year, and again,
they missed some of the bubble. I surrender. You're right. But if you don't listen to me now, you're taking the biggest risk of your life. Now you can make your own judgment. I have no problem with that. This is the hardest damn thing a person can possibly do, is fight a bubble, which every central bank is so committed to keep going that they will print $5 trillion. Yeah, $5 trillion been printed just since COVID by the Federal Reserve. That's what I'm fighting. But I'm telling you, if you think you can keep printing exponentially more money and keep a bubble going forever, then you have not studied history and you're the insane one. So I'm standing by my forecast. Yes, I'd rather be early than late. What did I just say? First crash could be as high as 55% in 2 to 3 months. That's what we're looking at. You want another 5%? 10%, maybe I'm early, fine. If you risk that and you're wrong, you could be down 50% before you know it. That's just what I'm telling you.
Or 20% if one would have pulled out in April of last year, as you suggested then. But I hear your point. Look, it's very hard to time the markets.
You got to weigh the risk versus the returns here. Every time this market goes up another 5 or 10%, the downside gets higher and the risk of the bubble bursting gets higher. But you're right. There is no way when a bubble is being orchestrated. It's one thing when it's a natural bubble, okay? And when it's being orchestrated by central banks and they're fighting it, there's no way to predict it exactly. But you got to know the risk.
Well, to your point, because as you say, as you contend that the bubble is being orchestrated by central banks and the Fed is clearly aware of previous taper tantrums. Managing the stock market is obviously not an official Fed mandate, but it may as well be the way the Fed responds to market reaction. So you don't see the Fed stepping in, trying to prevent a crash, especially one as dire as you are forecasting?
What are they doing right now? They're stepping back. They're stepping back cautiously. Now, once you start stepping back, if you turn around and instantly goose it again, you're going to look like you're idiots and you're crazy. So they're already compromising themselves. Why? Because they keep pushing the bubble bigger, and the economy, you can only squeeze so much juice out of a lemon. The economy is not responding. I mean, it's $5 trillion in 2 years. We should be growing at 20% a year. So you get less and less as this escalates until basically the central banks lose the war. There is no way they win this war, because next time, if they printed 5 trillion since COVID, next time when we crash, they're gonna have to print 10 trillion. Where does it get so ridiculous that nobody has any faith in anymore? And that's what makes it hard to predict. I'm saying I think we're there. That's just my opinion. You can ignore it all you want at your risk. And I'd be glad to come back on in 4 months. I think this is going to happen first or second quarter. I think that first crash is going to happen within 2 or 3 months as usual. And if it doesn't happen by then, I'll just say, okay, I was wrong. But
well, look, firstly, Harry, we have you on here because we want your opinion. And as I say, I applaud you for sticking your neck out and giving timelines when a lot of analysts avoid specifics.
Who will do this these days? Nobody.
All right. So you're saying first quarter, by the end of the first quarter of 2022 is when this bubble begins to burst.
Yeah, I think it begins in the next 3 months, and you will see that first crash by history within 3 months of that. So in the first half of this year, yes, I think you're going to see this 45 to 55% crash, and it will come very fast when it comes. And how much more can the market go up when it's already gone up this much against all the trends? By the way, the demographic trends, which I uniquely created that system, which caused the greatest boom in history in 2007, have been down from 2008 and do not bottom in demographic trends until late 2023. So we're fighting slowing natural trends in spending. And of course, when the government makes money easy and sends money, they're sending me checks in the mail. This is insanity, okay? They're not even being discriminating and sending it to the everyday person. I'm getting checks in the mail. So of course, people are going to spend more money.
So what's the trigger here, Harry? What is the straw that breaks the camel's back?
You know what it is? There doesn't have to be a trigger. You know, the 2000 top, the first tech bubble, there was no trigger. There was no recession, no big slowdown in the economy. Stocks just got so extremely up. And then what happened was the internet stocks, which were babies back then, came on top of the NASDAQ stocks, and they were part of the NASDAQ, and they really triggered the bubble because they threw the NASDAQ straight up. Well, now the baby stocks are the cryptos, and they're not in the NASDAQ, okay? But the cryptos are doing the same thing the internet stocks did in 99, early 2000. And so it just goes until it gets so extreme that the smart money starts selling.
So you think this next crash will be triggered by people pulling out of cryptocurrencies? You think that's the string?
No, I think the smart money will start shorting stocks and cryptos, and then all these people that piled in, it's the dumb money, I hate to say it, the everyday person that piles in the last 6 to 12 months, just like in 99. And when the smart money starts selling, it doesn't take much for them because all these people are overcommitted, and then they get scared because they're not sophisticated investors. So all it takes is to get the markets to go down, I think, a little over 20%, and people will start panicking. But it takes the smart money to trigger. The dumb money is not going to trigger this. The smart money is going to say enough is enough. And again, that you just have to look for and see when there's market weakness. And we had the first week of the year is usually strong. Well, guess what? We had strong market weakness on Wednesday here, January 5th. Okay. Why did that happen? There was no reason for that. No reason whatsoever. There
was a reason. Markets were responding to the Fed minutes, which indicated that the tapering scale is going to accelerate, as well as potential raising rates and hikes. Fair enough. But we're getting a sense of a more aggressive Fed here. But Harry, tell me, how are you positioned then? If this is the scenario that you're forecasting, how are you positioning your assets and your portfolio?
Okay, it's really simple. And that's why this debate with Peter Schiff on January 19th we're having. You can see this two ways, that what the governments keep printing more until you get inflation out of control. And of course, it's 6.8%, and we're going to get a new report on the 12th of January soon. It's probably going to be higher than that. And you get like an inflationary blowout. I'm predicting that when stocks and financial assets start to crash and people start selling those, you're going to get deflation. Money gets destroyed. There are trillions and trillions and trillions of dollars been built up just in financial assets from this money printing. It hasn't caused the economy to be super strong. It's caused the biggest financial asset bubble in history. When people start selling those financial assets, wealth disappears and people panic more. And then that causes the recession. The financial asset crash actually triggers the recession, which is more what happened in the 2000 crash. First tech bubble burst, now second tech bubble, and bubble in real estate, second bubble in real estate, second bubble in gold. Everything is bubbled this time. So it's the financial asset bubble that triggers a recession, and then the recession makes the financial asset bubble crash more.
All right, so you're saying that there are no safe assets to be positioned in for this?
There are always safe assets. It's just narrow. I'll tell you what the safest asset is, and this is true in the early 30s, as in 2008. Gold went up in the early part of that 2008 crash. And then when it got severe in Lehman Brothers, gold went down, everything crashed except for one thing: US Treasury bonds and AAA corporate bonds. So it's the long-term bonds that lock in a rate. Like people say, well, wait a minute, the Treasury bond, 30 years, 2%. How can it go much lower? Oh, it can go to damn near zero. And there's plenty of government bonds around the world that are already at zero or negative. So the bonds tend to react to the downturn. The safe bonds, only the Treasury bonds and the AAA corporates go up in value. Other bonds have risk of default going up in such a downturn. So they go down in value. And of course, stocks go down the most and real estate in between. So that's what happens. The Treasury bonds and the 30-year is the longest duration. I'm telling you, if you can be in cash and preserve your assets while everything go down. That's good. If you want to do great, you buy the 30-year US Treasury bond, and that can go up 40 to 50%. And it did so in 2008. For example, and this downturn is going to be worse for real estate.
Okay, so
worse for stocks.
You're recommending that people pull their money out of the markets, out of the housing market as well, out of cryptocurrency
as much as you can. I mean, people are not going to sell a home they're going to be in the rest of their life. But if you have a vacation home that you use for a few weeks a year, yeah, I would advise selling it. Vacation homes bubble more and go down more. So yes, sell the risk assets you don't want to hold through this, which is everything you can. The more you sell, the better. That's all I'm saying. It's your choice of what you sell or don't.
So sit in cash, and you've got the likes of Ray Dalio and others saying cash is trash, that the last thing you absolutely want to be doing right now
Ray Dalio is
making
a huge, I love Ray Dalio. He's making a huge mistake here. He has not studied these bubble crashes like I have all throughout history. Cash is good. Whatever you have, you pull your money out of the markets at the highest I'm telling you, the highest you're going to see stocks and real estate, maybe for the rest of your lifetime, okay? You're pulling it out at the top, and then everything goes down, and you rebuy with that cash. That's a great strategy. But if you put it in the Treasury bonds, they will be the one asset. Treasury and AAA corporates, the very safest long-term bonds, have proven, especially in the most recent crash, 2008, to go up 30, 40, maybe even 50%. So you're growing your money in the crash and then rebuying real estate and stocks at the lowest price of your lifetime. I know this sounds extreme. I don't like to be extreme, okay? I was bubble guy and everybody loved me when it's going to go higher and higher. No, this is the reality. Greatest bubble in history, crash. Governments push it up totally artificially more than any time in history. This entire rally since 2009 has been 100% artificial. And now you got to crash and shake out all that nonsense, and then you can reinvest again. Now, if you want to sit and wait, sit and wait. I'm just telling you the reality of what history says. If I'm right and the biggest bubble in history is about to burst, this is how it works out.
So, Harry, what percentage of your assets are in cash right now?
Oh, I have no money in the markets right now. I bought a house in Puerto Rico because it's a different market and gringos are moving down here for the tax advantages, and I got the bargain. I was renting for years, but I finally bought a house. It's such a bargain, but that's the only asset I own. I have no money in stocks or things like that in financial assets.
Now let's focus on why you have so much faith in treasuries, because this kind of crash would indicate perhaps a loss of faith in the US government and in the US economy and in the US being able to manage its monetary policies. Why would people all of a sudden feel so much safer putting their money in 30-year treasuries when a lot of this crash could be attributed to bad or unsound economic policies out of the US? And a lot of people saying that the US is on the verge of maybe not today, maybe not tomorrow, but at some point losing its status as the global reserve currency. So why would you feel safe in treasuries?
Okay. Remember this sentence, one sentence: best house in a bad neighborhood. Remember that. It's just 5 words, okay? And this is what happened in 2008. This happened. US was in debt. US had problems. Everybody else did, but the US dollar went up the most, held up and went up in the crash. The US Treasury bonds did the best because it's the best house in a bad neighborhood. We're still the strongest military power in the world, still the largest economy in the world. China is way more in debt and bubbled up than we are, and especially real estate. Average Chinese citizen has 75% of their net worth in real estate that's 2 to 3 times as overvalued as ours, and ours is overvalued. We're the best house in a bad neighborhood. Our demographic trends are still down, but Europe's are worse and never come back. Japan never comes back. China is the only emerging country in the world. I study this stuff, okay? Its demographic trends and spending have already peaked. They are aging faster than any emerging country in the world and faster than most developed countries, and nobody looks under the hood and sees that. China is largely done, and they have 22% minimum empty homes and buildings that only weigh down a crash and cause real estate to fall hard. The biggest real estate bust in the world will not be in the United States, it will be in China. And those people have 75% of their net worth in real estate. So imagine the pain there. This is what happens when a bubble bursts. I don't want to, people love me when I was so bullish in the 80s and 90s. Oh yeah, Dow 10,000 and Dow 30,000, all love that, but they don't want to hear the other side. No bubble and no bull market ever is not followed by a bear market and a bubble burst if it's a bubble. End of story.
All right, so you say best house in a bad neighborhood. I like to say cleanest shirt in the dirty laundry basket. But that was before, or the 2008 example was before we had a lot of interest in Bitcoin. So is Bitcoin and cryptocurrencies the potential beneficiaries of this, especially if there's a loss of faith in governments? Perhaps Bitcoin represents a whole other neighborhood. What's your outlook on Bitcoin during all of this?
Okay, that's a great question. Yes and no. In the short term, guess what's been the biggest bubble of all in this late stage bubble? Just like, again, I'm comparing the crypto companies to the dot-com, not all the internet, not all the NASDAQ companies, to the dot-coms, which were just emerging. Amazon was at $6 in 97, went to 136 and then crashed back to 6 in that crash early 2000. I'm comparing it to that. So crypto will get hit the hardest. I'm predicting Bitcoin will go down to 4,000 to 7,000 roughly, 90+% crash, more than the Dow and the NASDAQ and stocks in China and stuff like that. But on the flip side, yes, this is the next emerging tech sector. Think about PCs in the late personal computers, late 70s, early 80s, and then they boom. And then the internet to connect all those in the 90s. And then now that's peaking and maturing. Crypto is the next wave of technology. And let me give you one sentence for that because it's complex, but it's the digitization of all financial assets and money in the world. And Bitcoin just might end up being the global standard, which the dollar will not be. The US is going to lose its reserve currency status at some point. We're not the greatest country in the world as far as you go out, as Asia rises. We can't be. I think Bitcoin could become that new standard. We'll have to see. But the crypto is in its infancy. And just like the internet was in its infancy and now has bubbled into 2021, I see crypto being at its best at about 2037 to 2040. I will be damn near dead by then.
All right.
Another forecast I'll make in public.
All right, let's circle back there, because on the one hand, you're saying you see Bitcoin potentially as a global reserve currency or the new standard, like the equivalent of the gold standard. You see that happening for Bitcoin by 2037. You put that number out there.
Yeah, yes, it's not large enough to back. I mean, already though, I mean, Bitcoin continues to grow. It will overtake gold. Gold is not large enough to back the world economy anymore. Gold has not grown at the same rate, just like most commodities, as has the global economy. So this digital source, Bitcoin, has the potential to do that in these crypto companies. Now, there's 9,000 crypto coins. You know why there's so many coins? Because it's the cheapest way to do an IPO, a dirt cheap way to do IPO. If that many crazy companies did that, guess what? Most of them are going to go under. So crypto is going to crash. Bitcoin and Ethereum and some of the strongest are going to come out of this on the other side. And I'll tell you, if I'm right and we have the biggest crash in our lifetimes into late 2023, most of it hitting in 2022, and again, that's my forecast, the first thing I'd be buying is crypto, the strongest crypto companies, things like Bitcoin and Ethereum on the other side, Cardano, Solana, whichever ones prove to survive, but most of these things are fly-by-night companies and they're going to disappear.
So you're saying take your profits off the table when it comes to cryptocurrencies.
Including crypto, and most of crypto. And that would be one of the first places, well, where I want to buy in the flip side, because you got to look at both sides. If you do preserve your money and we have this big crash, the biggest opportunity comes when you reinvest when everything's on the biggest sale in history. So, but you don't read, it's not like the 80s and 90s boom where everything boomed everywhere in the world. So it is going to be Asia and more India than China and Southeast Asia. So I want to be India, Southeast Asia. And in the US, yes, the best tech sector should be things like the whole crypto sector as it moves out of infancy in its first baby crash, just like the internets and Amazon had its baby crash. I compare Amazon to Bitcoin indirectly, and then they'll have a big boom into the 2030s.
All right, but you're saying sell now and keep your cash on hand so you can take advantage of this on the other side across the board, from housing, from equities to cryptocurrencies. You're dissolving your positions.
Now, I'll back up a little bit more, the stocks and cryptocurrencies, because real estate is a maturing asset, okay? Most developed countries, even if we have a crash and turnaround and the millennials come along, houses last forever. We don't ever need to build another house in this country to fully accommodate the millennial generation because they're not as big. They don't go to new heights and births and people as the baby boom did. So real estate is not, it will come back, but not as strong. Stocks and crypto will be where I want to focus. And of course, Southeast Asia and India will be the best parts of the world, just like China did even better than the United States in this last boom.
Why Southeast Asia?
Because that's where the demographics are. Well, two things. All emerging countries have positive demographics, except for a few, okay? And China is one of those. China's demographics and their spending wave, I call it, has already peaked in 2011 and is declining, okay? But most countries have that. But countries have very different productivity levels and how much they grow. I can monitor, and I do monitor every major emerging country in the world. I plot them on a straight line correlation, urbanization and increase in GDP per capita for every percent urbanization. And India is one of the fastest growing. Nobody thinks that. In China, not as fast as India. And all these countries have different trajectories based on how productive their infrastructures and how good their political systems are. So these emerging countries will dominate the next boom. All developed countries have peaked except for Australia, New Zealand, and Sweden, and a few small ones. So the emerging countries will dominate this next boom, but I'll be able to tell people which ones have the best trajectories because this is already put in motion on this urbanization versus GDP per capita. Straight line relationship in most countries.
Well, you focus a lot on demographics. That is the basis of a lot of your analysis. You did correctly forecast the crash of the Japanese stock market in 1989 and in the 90s based on demographic trends. And you're comparing the current US situation to that of Japan back then in the early 1990s. So expand on that. What are the similarities?
First of all, Japan's Nikkei never got back to 40,000 and never will as long as I'm living. And most people are listening to this, okay? We will not see US stocks with the millennials, since we have a more substantial millennial generation, but still nothing like the baby boom, could get back to these levels in the next boom, 2037. But we're not going to see stocks just go to the moon. To see stock markets that are going to go to major new highs, you're going to have to go in the best part of the world with productivity, Asia, and in Southeast Asia and India, because China's already 64% urban and has overbuilt their infrastructures 25%, so that they don't need any more infrastructures to fully urbanize. So India is going to need to expand like China, Southeast Asia, and Asia has the demographics. Look at Africa. Africa countries have great demographics, but they have poor infrastructures and they have poor projections for growth in GDP per capita with urbanization. So that's why I'm telling people India, Southeast Asia, globally, and US, particularly in the crypto and new technology sectors when we come out of this crash. But you've got to preserve your money. If you lose 70, 80% of your financial assets, or even 50, you're going to have less to invest in the next great boom, and you'd be lucky to get back to even. That's not a good way to play.
But part of your thesis is slowing population growth. Which is part of the problem.
That's a fact.
But the US still has a pretty high rate of migration. How does that factor in?
Okay, you think people will migrate? Well, but people are. We've had a backlash. How long? And how did Trump get so popular? Keep the immigrants out, Okay. Imagine a big downturn. Immigration will disappear, and anybody that wants to get in probably won't get let in. Immigration will slow down. It slowed down in the 30s, okay? So that will slow down. It'll come back maybe at some point. And the US is still an immigration magnet. Most of Europe is not. Japan never has been. China, not at all. Nobody immigrates to China, okay, to a lower standard of living. So this will also follow its course in the downturn, and then certain places will come back strong. But I think the immigration wave, we've already seen the strongest part of that, even globally. I mean, a lot of people have already moved around the world to where they're going to move. And this downturn is going to put a quick, this is a given. You have the type of downturn I'm talking about, immigration will come to a halt. That's not a prediction. That's a guarantee if I'm right about a heavy downturn like this.
All right. As we said, you are the contrarian's contrarian. And one of the issues that you're taking another approach on is that we're going to see deflation, not inflation, when all of this shakes out. Expand on that.
Yeah. Okay. So two important numbers. In the world, 300 billion now in debt, just so many times more than we've ever had out of this debt bubble. And that debt bubble always, and it fosters a financial asset bubble. We have about $540 trillion. That is over 6 times global GDP at 80 trillion-ish, okay? It's this financial asset bubble that's going to destroy money that are in people's, not just in their bank account or in their backyard, in their brokerage accounts, is going to disappear and come back very slowly, okay? That's going to cause deflation, less money in the world, chasing goods in the economy. I say we're having inflation trigger this, but that we see deflation. And guess what the 1930s was? Deflation in consumer prices, okay? And we didn't get back to those price levels for a long time. We didn't see stocks back, not real estate back, and we didn't see consumer prices come back. So I see deflation. Peter Schiff, who I am debating on January 19th, you can get debate 2022.com. You can sign up for that. People love this. We go at it harder than we're going at it, okay? Because we agree on the crash, but he thinks governments will just keep exponentially printing more money until we have more like hyperinflation. I think the deflation will set in so fast, these miserable central bankers will not have time to react. That's my theory. And we end up in deflation. He says we'll end up in a hyperinflation like Germany did in the 1920s.
We've had Peter Schiff on Kitco several times, including a recent debate where he did take that position. And he does maintain that gold is the best way to protect yourself against that. Clearly, you disagree. What's your outlook on gold then in this scenario?
That's an important distinction because we both see a crash, okay? That we don't disagree on that at all. In an inflationary outcome, yes, gold is the ultimate inflation hedge. You know, there's others, but gold is the ultimate. Treasury bonds, the highest quality bonds, are the ultimate deflation hedge. In deflation, remember what I said, $540 trillion in financial assets are going to see $200 to $250 trillion, okay? That's 3 times global GDP right there. Disappear. Money disappeared. People are not going to feel as rich. They're not going to spend as much after that. And that causes deflation in prices, money disappearing around the world, and slower spending to follow for years on top of that. But it's the deflation of that financial asset bubble that I'm.
So what's your outlook on gold then? How do you see gold ending 2022?
Okay, gold will go down. My prediction long term has been gold will end up going back near its lows back, I think in 2015, $900 to $1,000. That will be only a 50% crash roughly. That'll be less than other commodities, less than stocks, a little more than real estate. So gold will hold up better than most other commodities because of its kind of, glow and special status. But no, gold will go up as long as they're printing money or we're expecting to get higher inflation. If we see deflation, and we're going to see it in 2022, if I'm right, gold will not go up. And gold, same thing. 2008, they're printing, we're getting in trouble. They're going to print money. Then we did touch deflation very briefly in mid to late 2008. Gold crashed 50% in just a couple of months. So gold went up in the early stages, and that could happen again. I think less likely, Michelle, because people already saw gold fail. Gold was not the savior. So the difference between me and Peter Schiff, Same big crash, same big crisis from the same money printing and irresponsible policies for decades now. But he sees gold and precious metals will be the best safe haven. I see the highest quality government and corporate bonds being the safe haven, and cash if you have to. I'd rather have the bonds.
All right. Well, Harry, you are a brave man for putting it out there yet again, giving us a very, very detailed analysis of what you expect. Thank you so much for sharing your words of wisdom with us. Appreciate it.
Hey, real quick, Michelle, also, I mean, again, remember this, the debate 2022.com. This people love this debate. We did one last year. Okay. Also, harrydent.com. I have a normal newsletter, but I have a free weekly newsletter. Anybody can get on and get to know us. I know this is stark what I'm saying, but people thought I was just as crazy when I was overly bullish in the 80s as I am overly bearish now. So if you want to get to know us, harrydent.com, free newsletter.
All right, Harry, thank you so much. Our viewers will check that out. We appreciate you joining us here on Kitco News. Thank you.